Hey guys, I don't know about you, but I'm getting really fed up of all these interest rate rises. The Bank of England have yet again increased the base rate by 0.25% to 4.25%. And guess what? They unexpectedly saw inflation rise to 10.4%. So it's not like all these rate rises are actually helping inflation to fall. It actually unexpectedly rose. And yet again, they have to crank up those interest rates again. And who pays for it? You do. And I do. No one talks about that. Everyone's just like, yeah, it's a bank rate rise. It's happened again. Sorry, you have to find more money this month. I'm really fed up with that. It's the 11th consecutive rate rise. And there are no signs that they're going to stop raising rates, even though inflation remains at double digits, even though we keep getting promised, yes, those inflation numbers will fall down to this dreamy 2%. It's not going to happen anytime soon, but I'm going to wait to be corrected. Today I want to walk you guys through what the whole rate rise thing actually means for our personal finances. What does it mean for your mortgages, if you're renting a property, your savings, your investments, your debt, all those things. Now, on the back of this rate rise, the Americans, the Fed, also increased interest rates by 0.25%. So the Bank of England pretty much mirrored what happened there, even though the UK economy is obviously vastly different to the US economy. The decision-making people, 9 people, men and women, just like us, who sit in a room and make these decisions that affect everybody, 7 of them increased the rate by 0.25% and 2 of them chose to stay put. But of course, they got overruled by the 7 people. Now, there were some notable events that the people who make these decisions had to consider on the way to deciding to increase the rate by 0.25%. I'm going to read my notes here to make sure that I'm telling you exactly what I've written down to guide me on this video. The first is the failure of the Silicon Valley Bank. And on the back of that, the challenges that we've had with Credit Suisse and the UBS acquiring them and all of that stuff, and the potential impact on the banking system here in the UK. So they had considered that, and I quote, reading this, it says here, reading the minutes of meetings from the Monetary Policy Committee, they said that the UK banking system maintains robust capital and strong liquidity positions and is well placed to continue supporting the economy in a wide range of economic scenarios, including a period of high interest rates. Essentially what they're saying there is, in simple layman's terms, things are good. There are no problems for us here in the UK. That sounds great, but I will keep an eye on that personally. I'm personally keeping an eye on it because I kind of think this banking thing, there could be more coming down the pipe. The second thing they considered was good news, which is that the UK wholesale gas prices had fallen in line with the rest of continental Europe. And that's great. However, they said this, and I quote, "On the one hand, low energy prices will push down headline inflation, and also core inflation via indirect or second round effects. On the other hand, lower energy prices would push up demand, which taken together with other factors pushing up GDP, which is the gross domestic product, and all else being equal would likely push up upward pressure on global inflation." Essentially what they're saying is that on one hand, the gas thing falling is great. Like, life's good. We're using less energy as we gradually move into spring and into the summer, soon. That's great, but it could also drive demand, and hence coming back to this same dreaded topic of inflation. The next thing they talked about is that the UK economy is now expected to narrowly avoid a recession. That's good news. Okay, again, narrowly. And then the next final thing they really went into detail on was then inflation, this unexpected rise in inflation. And here I'm talking about the 12-month CPI inflation that they unexpectedly saw increase to 10.4% in Feb only last month. That inflation was driven by rises in food prices as well as the likes of clothing and footwear and stuff like that. Okay. Now, interesting point about inflation, given it's the main thing that's driving the interest rates. Obviously, there are other things that are happening, but given this is the one thing that they always go back to, I looked at the minutes of meetings and it was very interesting, the statement that was included in there by the Bank of England relating to future inflation expectations. And I read, it says, I quote here, it says, the extent to which domestic inflationary pressures ease will depend on the evolution of the economy, including the impact of the significant increases in bank rates so far. And here's the key bit. Uncertainties around the financial and economic outlook have arisen. That all sounds, essentially what they're saying there is that they don't know what will happen. That's it, in simple layman's terms. They're effectively saying, stay tuned. Expect potential rises. That's literally what they're saying. And for me, I'm really quite fed up with all this, because if you think about what the media, if you think about like the last 2 months, a lot of the noise that really came out from the media was, hey, these rates are going to be falling. Everyone's like jumping up. And this went as high as, think of some of the most senior people in this country, all with the same messaging, which is that inflation is expected. It's going to like fall to the ground. But none of that is happening. And for me, I'm personally not holding my breath anymore when it comes to inflation. I've just assumed the worst. And I would highly recommend that you assume the worst too. Because if you think about it, when last did any of the forecasts that have been put out there actually become true? Think about it. None of them ever really become true. Yeah? This is given that the people who are giving us these forecasts have all the eyes and ears. They've got all the data. They've got all the analysts and all these things. If they can use the word unexpectedly, like, just think about that. Anyway, shifting gears, interest rate expectations. They've said that the market implied path of the bank rate, i.e. the base rate, is that they're expecting it to peak just a little above 4.5% in August 2023. Okay, so that's the expectations as far as interest rates are concerned. Let's talk about mortgages and rents now, because this is obviously this is where we all get affected because lots and lots of people have mortgages and lots of people are renting and so on. If you are one of the about 1.4 million people, or just over 1.4 million people who are on tracker and variable mortgages, if the rate rise is passed on to you, which you'd expect it would be straight away, you will be impacted to the tune of £34 per month if you have a mortgage of around £250,000. That's just a rough estimate, about £34 a month. Now there's a question there, which is, if you've got a variable rate, or if you're on the tracker or a variable rate, should you be fixing right now? Okay. What I would say to that is that the more you wait, the more likely it the more you wait, the more likely it will be that the fixed rates will start to come down, because the rates have started to come down if you pay very close attention to them. And I'll share some of those rates for you to see. So the decision really will depend on the extent to which you want to be able to predict your monthly expenses every single month. So someone like me, for example, I like to know what's coming. Like, I don't like to be surprised. I just want to know, do you know what? Here's how much I'm paying. I've budgeted for it and I'm ready. Yeah. So looking at the rates right now, I'm going to share some of the rates, looking at some of the best remortgage rates right now. A 2-year fixed, you can get a 2-year fixed, the best rate for a 60% loan to value though, of around 4.26% thereabouts. Yeah. This is for a remortgage. And a 5-year fixed on a remortgage, the best on a 60% loan to value is 3.89%. Now, obviously, these rates will get worse the higher that loan to value becomes. So like, for example, if you've got 80% or 90% loan to value, the rates are a lot higher than that, okay? So that's how I would look at it if I was someone who was thinking, should I consider remortgaging and so on? Personally, I would look to fix my mortgage rate, but I would look to do it for about 2 years thereabouts. And if I felt confident that I'm actually okay with the rates as they stand right now, because fixed rates, I'm looking here, 5-year fixed rate deal, you can get for as low as 3.89% right now. 5-year is a lot lower for a remortgage than a 2-year fixed rate. Yeah, so I personally, I'd take that. I'd take that any day and remove the uncertainty. Again, rates for people who are moving home. It says here a 2-year fixed 4.14% if you're moving home, and a 5-year fixed of 3.96%. Again, like, think about it. That's not, those rates are high, but if you believe in the next 5 years that you want to be able to predict what's happening with your finances and you don't want the turmoil of constant rate rises, then this might be something to consider right now. Now, if you're someone who is currently on a fixed rate mortgage, none of this will obviously affect you. 75% of mortgage holders are on a fixed rate. However, more than 1 million people, about 1.5 million people, will be coming out of those fixed rates this year. And so they'll be coming into the reality of those higher rates, which will obviously affect people and their personal finances on a monthly basis. Now, in terms of suggestions, it goes without saying, budgeting right now is important. If you can overpay for those people who are on those fixed rates, I've said this many times before because I believe so much in overpaying, particularly in this age of rising rates. It's definitely something worth considering if your budget obviously allows it, because this helps to improve your loan to value, which means you can get much better rates when you come to remortgage. Now, for renters, it's the reality with renting is that as these rates rise, those rates obviously affect landlords, and as landlords get affected, those landlords have to make hard decisions around increasing their rent for their properties. So chances are, if you are renting a property from a landlord who has not fixed their mortgage rates for their property, you will likely see an increase in your rent, unfortunately driven by these interest rate rises. Okay. Now, for first-time buyers, things are actually getting better, because I looked at the rates from my last update back in February, comparing them to right now. For first-time buyers, you can get a 2-year fixed rate for 4.5%. It's one of the really decent rates at a 90% loan to value. 5-year fix for first-time buyers is at around 4.3%, some of the best rates, again at a 90% loan to value. So obviously the more you can put down by way of a deposit, the better for a first-time buyer, the better rates you can get. But what I would say is definitely make sure you're seeking independent advice from a mortgage broker, because they can get you better deals, even because there's certain deals that are just not available on these public platforms. Now, looking at buy-to-let rates for people who are still interested in buy-to-lets and investing, the rates are actually better, interestingly. So some of the best rates for buy-to-lets for 2-year fixed are coming in at 3.99%. This is for a 65% loan to value though, yeah? And if you're looking, say, at a 5-year fixed, again, for a 60% loan to value, you can get those rates in at around 4.25% for some of the best rates when it comes to your buy-to-lets. Again, not crazy, obviously a lot higher, obviously eating into people's returns and so on, but not utterly insane, given how bad things were last autumn as well. So those rates have definitely improved somewhat, okay? Now, looking at debt, anyone who has any existing debts, here I'm talking like whether you've got like car loans and things like that, you wouldn't typically expect, these rate changes to affect you. But more generally, for people with credit cards, and credit card debt has been increasing in the last 6 to 12 months. With these rate rises, there will be no direct impacts from the Bank of England rate rise. But again, if you've got lots of credit card debts, again, the old kind of looking at 0% balance transfer credit cards might be what you might want to consider here. And if you've got much bigger loans, consolidating those loans might be the preferred approach for your debts. But again, please make sure you seek the right advice from a debt counselor to know what on earth to do when it comes to actually managing those debts. Looking at savings, obviously rate rises mean it is typically good news for savings, because for savers rather. And I here looking at the website Money Facts, which is where I looked at the rates I mentioned a lot earlier. I'm looking here for easy access accounts, 1-year fixed rate, and a regular savings account. Again, those rates have been easing up. Easy access rates, you can get them for around 3.4%. A 1-year fixed at 4.5% AER, and a regular saver at around 7% AER as well. Okay, so those rates are pretty good. And obviously we're in that end of tax year season. So, ISAs have become pretty, there are lots of people talking about ISAs. There are lots of offers out there for ISAs, making sure that, trying to lure people into these various accounts. Here I'm looking at, say, a fixed rate, a fixed rate ISA, rates on that at around 4.25%. Easy access ISAs, again, 3.2%, and so on. Lifetime ISA, the best rate for that at the moment is 3.5%. So there's some pretty decent rates, but all that to say, if inflation's at 10.4%, which, is the headline figure, the real rate of return, again, remains, pitiful, because, it'd be a negative 6% if you're receiving, a 4%. Return thereabouts from your savings. So although the real rate of return is negative, anything you can do to chip away at that is great. Personally, I put my money into a stocks and shares ISA. I've talked about this. If you've not seen a video made recently, I will link to it above for you to check out and why this is particularly important in this particular season as taxes are rising in the UK and so on. I personally think your ISA will become ever more important. So definitely check out that video, which I'll link to below and above for you guys. But personally, I will try and max out your ISA as much as you can before the tax year end arrives. As for investments, to be honest, with investments, things have just been going up and down. With all the uncertainties in the UK economy and in the global economy, it just looks a bit crazy with stock markets. Things go up, things go down. Personally, I've just focused on keeping my money invested in passive trackers, globally diversified and low cost. And I haven't sold anything. I've just literally focused on carrying on investing money. And that's literally been my focus. And in addition to that, putting money into any stocks that are well researched and paying dividends. That has been my focus essentially when it comes to investments. But overall, I just want to just zoom out a little bit, because I started this video really frustrated, and I still am. And the reason for that is because I just think that, we're all kind of walking into this normality of every other month we're told that interest rates are rising, yeah? But the inflation thing's not coming down. So what I would say from a personal thoughts perspective is just keep assuming the worst. Don't buy into the idea that inflation is going to drop to 2%. It sounds great, and I'd love to be proven wrong when it comes to that. But I actually think that we need to start to become accustomed, potentially, to a world where we have persistent inflation, where inflation is just going to remain high. Yes, global kind of energy prices, gas prices have fallen, but there are still so many uncertainties that mean that those inflation numbers, as they're predicting, dropping back to 2% or a really low number later in the year, I personally think is highly unlikely. But, we'll wait and see. Other things I want to say here are focus a lot on using your existing skills to earn more. A lot of people use their skills for their day jobs, and that's amazing. But as you can see, there's nobody out there handing you out an extra £34 because they've increased the base rate by 25 basis points. Nobody's giving you that money. So I would say focus here on using your existing skills to find new ways of earning more. Don't listen to anybody who tells you not to get a pay rise, because, not being funny, they keep increasing rates. If people are going to survive, people need to figure out a way of finding that money legally. And one way of doing that is using your existing skills or upskilling in another way. Obviously, it goes without saying that you should focus on making sure that you are showing up at work, doing your best to retain your job. Thankfully, unemployment rates are not rising as had been expected. So keep putting your best efforts in at work. And, overall, I just want to zoom out even further and just say something that's actually a bit personal, but I want to just share it here. In the last 8 days, I've been dealing with the passing of a family member, and it's been the most difficult thing I've ever had to deal with as an individual. And sometimes we can get so caught up on like all this stuff about interest rates and how it affects us and so on, and we forget that life is actually pretty fragile. Life is actually really, really short. So I'm saying that to say, do your best, even with all that's going on, with all these rate rises that are going on, do your best to focus on those things that bring you joy, even during these challenging times. Because I tell you, seeing a family member pass away really young, age 39, same age as me, and watching that happen, whilst everything else that we normally focus on is also happening, really just refocuses your mind on what is the most important thing in your life. And for me right now, it's enjoying every moment, enjoying this moment I'm making this video, enjoying my family life, enjoying every hour I'm alive and present with my children and with my wife, doing the small things that bring me joy, and doing my best with all these things when it comes to interest rates, not to really worry so much, but doing my best to stay positive and stay practical in managing our personal finances. Guys, that's it. If you've got any questions, let me know. I hope this video helped you. I've done my best to be as frank. I hope these videos, you can see, they're not edited. I just share what I think and I put it out there, and I hope it helps somebody move forward. If you've got any questions, please drop them in the comments below. But other than that, take care, and I'll see you on the next one. Bye for now. Oh, by the way, the next update's on the 11th of May, okay, which, yeah, I don't expect to be good news. But anyway, stay positive. Bye.